Hi, this is Brian Dolan from the law firm Pepper Hamilton. Each month, Pepper partner Greg Nowak hosts a webinar for West LegalEdcenter focusing on what's happening in the investment management world. This month discussed the impact of the Tax Act on funds, investors, and investment managers. This podcast is a recording of that webinar.
This is Greg Nowak from Pepper Hamilton. I'm a partner in the financial services group and the host of the program today. I'm joined by three of my colleagues here at Pepper Hamilton: Joan Arnold, the chair of our tax department; Jennifer O'Leary, a partner in our tax department; and David Stauber, also in our tax department. And the topic today is the Tax and Jobs Act of 2017, also known as the Trump Tax Act, and I think there's even a longer name that was officially included in the congressional record. But for this program, we're just going to call it the Tax Act to make it simpler for everybody. And it is a far-reaching piece of legislation. Now, I've been practicing law long enough to remember some other massive changes to the federal tax code, including back in 1986 that gave us the current Internal Revenue Code of 1986. And the process there was a bit more deliberative, I guess is the best way to describe it. First, we had a House bill. Then we had a Senate bill, and there were conference reports produced by both the House and the Senate. Then there was a conference committee, and that produced an entire report. And then there was a thing prepared called the Blue Book that described it all. And we also had the President's bill that was overlaid, reconciled finally in the conference report that gave us the Tax Reform Act of 1986. The process this year was, shall we say, a little bit truncated, or should I say trumpicated?
Well, it actually was the same process. The only problem is that instead of taking 2 years to do it, we did it in 6 weeks, which meant that there are significant holes, notwithstanding Mr. Muchin's comment that he hasn't seen anything that requires a Technical Corrections Act. Those of us who are actually trying to apply the laws that have been written recognize that there are massive craters of unknown. So we are using our best judgment as to how we will fill them in. The Joint Committee is currently at work on this year's version of the Blue Book, which will be the Joint Committee's technical explanation of the bill. And that is going to be, we think, where we're going to find a lot of the fillers. We don't think that there's going to be a Technical Corrections Act because that would require the Democrats weighing in and getting involved in this transaction. We don't think that that's...
Well, stop for a second there. Explain that. This bill was passed as part of the reconciliation process.
Yes.
Which meant they only needed 51 votes in the Senate.
Right.
And a simple majority in the House.
And that's why, by the way, the name of the bill had to change. Because under the reconciliation process, the only thing you can talk about are budgetary items. And since the name of the bill included the word jobs, they couldn't pass it under the reconciliation process, which is why we have a different name that nobody's using. But if they want to do a Technical Corrections Act, that can't go through the reconciliation process, which means that they need 60 votes in the Senate to get it passed, which means they need the Democrats to weigh in, and the Democrats are basically saying to the Republicans, you wrote this, you live with it. We're not going to raise a finger to help you actually implement it.
Now, theoretically, the Republicans could, in the Senate, do exactly what they did with the judges and invoke the nuclear option and change the rules and go back to a 51% majority, correct? Because the Constitution allows the Senate. I
don't think there's appetite for doing that in this case. But they can do lots of stuff. But I'm not hearing that as something that they're thinking about taking and implementing.
And again, what you'll see, I think, is the administration trying to fill in those gaps through the regulatory process, which will be a very interesting development.
Well, they're in the process, and Treasury is working round the clock to give as much guidance as they can to things that are an immediate issue. They've come out with a couple of notices. They were principally focused on what happened in 2017 to taxpayers who had to pay tax on all of their historic foreign earnings. They are putting together notices on quite a number of topics. We've got an ABA meeting in 2 weeks. They usually come out with a bunch of stuff before that. We're looking for a lot of notices before that. We don't expect regs for years. They've told us, regs are not really on the horizon. We're going to have to deal with notices for a long period of time, and we will ultimately get around to writing regs.
So, again, from the tax practitioner's point of view, notices are substantial authority and can support an opinion?
Yes, they are. They're substantial authority. They can support an opinion. The level of opinion that one can get based on, it's fine for filing. Whether or not we'll be able to give a real comfort level in terms of what we think the right answer is will depend on what the notice says.
And for those of you listening, the opinion bar of tax professionals has stratified quality of opinions from a will, which was, of course, 100%, or
no, it's 90
or 90%. That's right, because no one can ever
say will.
Exactly. But then you have should, could, more likely than not, realistic possibility of success on the merits, and the giggle test, right?
Yeah, we don't write opinions on the giggle test.
Right, so no one ever gets that low, but realistic possibility of success on the merits is usually defined as a 1/3 probability, correct? And that's a filing position and would get you out of the accuracy penalty.
Right.
So just so everybody understands, the bar here is actually pretty low based upon the guidance that we're getting, and so the uncertainties that Joan pointed out will dog us for a long time to come as we try to implement this and order our affairs to properly pay taxes and make sure investors in funds that are managed, etc., are correct and reported. Yes, Jennifer.
People have to file tax returns based on this new law next year. I mean, there are a couple of provisions that actually went into effect, of course, in 2017.
Right.
So people will actually be filing tax returns based on that quite soon.
Right.
But the vast majority of these provisions go into effect right now in 2018.
Well, are they all for fiscal years that begin after December 31?
No, there are some very interesting questions as to how the fiscal years apply. There are a couple of extremely large West Coast companies that got an enormous benefit because they're fiscal year taxpayers with respect to when they have to pay the tax on their foreign earnings. So you need to carefully look at it if your fiscal year. And if you attempted to, they were very clever in drafting the effective dates such that if you tried to change your year-end after the bill was, or during the period when the bill was being debated, it probably didn't work to change when the bill hit you. So, again, the fiscal year taxpayers have a fairly complicated analysis section by section as to when each section applies.
And that's actually a very important point here. There's no rule of general applicability. Many of them are effective for taxpayers whose tax years began January 1st.
Yeah.
But if you have an odd year, and many in the fund industry do because of the way that income is generated, especially advisors and certainly funds, in order to try to move around the tax filing burden. Partnerships are different. They're almost all on calendar years. But obviously you need to take a hard look at the effective date provisions, see how they apply, and keep close tabs with your tax advisors on that one. So enough with the preliminary matters. Let's talk about what actually happened as a result of the Tax Act. The first slide, our topics today: rates and choice of entity, current expensing of tangible property, limitation on interest deductibility, and loss limitation for investors. There's a myriad of other topics. We only have an hour, so we're only going to cover these, but we are going to try to do it with some degree of detail. And these topics were chosen, obviously, because they're of interest to investment advisors for their own affairs, in ordering their own affairs, as well as attempting to value the impact of these tax changes on the companies in which they invest. The tax changes will have material impact on what happens to valuations, and so therefore, understanding what changes were brought by the bill will help you in that analysis. So without further ado, slide 3, Joan, tell us what happened with rates and choice of entity.
Okay, so For the vast majority of my career, which spans a number of decades, it was very clear that the advice is that all businesses, to the extent you can, if you're not public, should strongly consider being in pass-through, in either a partnership format or an S corporation or a sole proprietorship if you're a single-member LLC. And there were a number of reasons for that. The most compelling of which was that you had a two-tier system, so that you pay tax at the corporate level, and then you pay tax again when you take the money out, and the shareholders are taxed. And that was always the case when the tax rates were 35% corporate and then 40% or 20% for dividends. Individuals, you'd be over 50% in a tax rate. What has changed now, and this is a permanent change, unless and until we get a Democratic Senate, the top tax rate, not the effective rate, but the top statutory tax rate for a corporation is now 21% as of January 1st, 2017. So what does that mean? Well, if I've got an operating corporation and it earns $100 and it pays $21 in tax, I've got $79 left. I dividend it out to my shareholder, assuming my shareholder's at the top capital gains rate. They pay tax at 23.8%. So my total tax rate is 39.8%, which was, in 2017, pretty close to the individual highest tax rate. So we have now reduced the overall tax rate by a very considerable amount.
So what's the shareholder rate, 23.8? Is that a specific tax on dividends, or how does that work?
Yeah, the dividend tax, a dividend is taxed as capital gains. The maximum dividend tax rate, maximum capital gains rate is 20%. So the maximum rate on a dividend, a qualified dividend from a U.S. corporation, is 20%, and the 3.8% is the continuation of the Obamacare tax on investment income.
For Medicare purposes.
Medicare. Well, it actually doesn't go to Medicare, but that's what people refer to it as.
Got it.
It's just a general tax. Okay. There's a line here that says, don't forget salt, and I don't mean salt and pepper. What I mean is state and local taxes. People are saying, okay, I'm going to become a C Corp. This is great. Well, if you do, my home state, which is Pennsylvania, we have a 10% corporate tax rate. So that becomes quite an additional element when you're trying to figure out what your choice of entity ought to be, because our individual tax rate is only 3%. So don't forget your salt.
Is it possible in certain states to maintain a C Corp for federal purposes, but a pass-through for state?
That is a historic planning device that has been, for the most part, shut down. Well, when you're not talking about the S play. You're talking about keeping it an LLC.
Yes. So you file a federal election to be taxed as an association for federal,
right?
And then you allow pass-through for the state.
Very, very few states will allow that anymore.
The one nice thing, and I'm not a fan of being a corporation for tax purposes, but the one nice thing is that a corporation can still deduct the state and local tax.
Right.
So that is one nice thing about being a corporation.
So it takes the sting out of that 10%. Now,
somewhat.
What about, there used to be accumulated earnings taxes and other prohibitions about accumulating income inside a C Corp.
Yeah, and when we get to some deal structures, we'll talk about it more. But the accumulated earnings tax is still on the books. When I teach, I spend at least 15 minutes on it out of a semester because it hasn't been something that the IRS has focused on much at all. But it exists, and we'll talk about why you might want to be a corporation now, and that's something that may well come back to have people have to think about more.
Now, one of the non-tax reasons, of course, to be a C Corp is from a securities point of view, it does open up opportunities for gathering assets on a more generalized basis. You can do a general solicitation with the C Corp a lot more readily than you can with a partnership or a pass-through. And S Corps, of course, limit the number of shareholders that you can have. Silicon Valley traditionally has opted immediately for the C Corp.
Well, Silicon Valley opted for the C Corp because the lawyers could more readily sell a prepackaged form of documents that you could say, okay, you're going to be a startup. Here's your C Corp articles of incorporation. That's $5,000. We'll see you. I would say that there is a major split between the East Coast and the West Coast. On the East Coast, and what you would hear is that the VCs will only come into corporations. If you're on the West Coast, that's the advice that VCs got. On the East Coast, VCs have, for at least the last 5 years, said, hey, wait a minute. If we go into an LLC, we have all kinds of benefits.
Right.
And so East Coast VCs will not only be willing to go into LLCs, but are very frequently looking for LLC investments. And maybe we should go back to the slide and talk a little bit about the rates on choice of entity. So if you've got a member that's a member in an OpCo that's an LLC that's taxed as a partnership, the OpCo generally will be making tax distributions to the member to cover their taxes. The top individual rate is 37%, but if the 20% deduction is available that we'll go and start talking about in just a minute, the effective tax rate of that member can be reduced to 29.6%. So if you're looking just at what the operating company might need to do in terms of cash flow in order to cover the various tax liabilities, in the OpCo structure, the corporation, it needs to fund a 21% federal tax liability. In the LLC format, it's going to need to fund, even at the best, a 29.6% rate. So the availability of the cash flow in the corporate structure is significantly greater. Significantly greater to the point where people are saying, maybe, even though I don't have the benefits of the LLC, which are significant, maybe if I have enough cash flow, I can build the business to a point where my EBITDA is so much greater that I can get a greater multiple, even if I can't get the tax benefits of being in a corporation. And that's the conversation we're having with a lot of our venture clients now, who say, yes, I understand that if I remain a partnership, when I sell, I can deliver to my buyer a complete step up in assets. They can expense it. They can amortize some of it. But if I have to distribute 40% of my earnings in order to pay taxes, I have so much less to invest in the business that the tax benefit is not going to be enough to overcome the benefit I get from being able to increase my revenue.
Another interesting side benefit to the corporate structure, believe it or not, especially with the lower rate, is that those firms that have elected to do ICOs, initial coin offerings, where they attempt to treat the coin as a utility as opposed to any form of equity security, the proceeds are going to be taxed at a lower 21% rate as opposed to the highest corporate rate. So there's significant savings there.
Yeah, I haven't seen any ICOs even considering going out in partnership form because of the publicly traded partnership issues.
Well, if they're not trading equity, if they're trading coin, it's the utility coin. But we digress.
Yeah,
that's a very specialized discussion. Stay tuned for next month. We are going to talk about initial coin offerings then. That's sort of a shameless plug for next month's program. Okay, going to slide 4. We've heard a lot about this 20% deduction. How does that work?
Well, first of all, it only works for the years 2018 through 2015. It sunsets after that.
You mean 2025?
I'm sorry, 2025. Sorry. Yeah. It sunsets after that. So this is a short-term opportunity, and you need to factor that in when you're doing any type of modeling. It only applies to individuals, trusts, and estates. And at its best, individuals can deduct on their individual return up to 20% of qualified business income. So this does not say that we're going to tax pass-through entities at 20%. This doesn't say that the entity gets to take a deduction. What it says is that ultimately the people at the top, the arms and legs at the top of the structure, to the extent it applies to them, they can take a deduction of 20% of their qualified business income. It can come from S-corps. It can come from LLCs that are taxed as partnerships. It can come from sole proprietorships. Sole proprietorships include single-member LLCs. So since it can come from sole proprietorships, it's not actually something that's limited to flow-through entities, but that's the way it's been spoken of in generic sense. specified services, except for people who make a very little bit amount of money, are excluded from this. So if the business that's involved is health, services rendered in the health field, and by the way, that basically just means doctors. It doesn't mean people who are doing testing or other lab-type exercises. But people who are in the health field, law, accounting, actuarial services, investment banking services, or an asset in which the principal asset is the reputation. The slide says repetitive. It should say reputation. Reputation of the employees. In general, a 20% deduction doesn't apply. Up until the day before the bill was passed, architects and engineers were also included in specified services, but overnight they became very popular, and now they are not part of the excluded classes.
So somebody who is for example, a guest commentator on Fox News or CNN who receives a fairly significant stipend for that, that's a performing art, or is that a principal asset in which reputation?
It's the reputation.
So
you're not going to be able to get that.
So you're not going to be able to get the pass-through, even if you have a single.
You're not going to be able to. It won't be qualified business income.
Got it.
And therefore, unless you are below a certain level, and the level is effectively $415,000, and we'll talk about that a little bit more. But unless you're below a certain level. Let's go to the next slide and just look at
But this is an important one. It applies to qualified REIT dividends and qualified PTP income.
Mm-hmm.
How does that work? Like, if I have a pipeline company that's a qualified publicly traded partnership and therefore gets pass-through treatment, this will apply to a pipeline company under the publicly traded partnership rules?
So essentially any income that's passed through, as Joan said, this is a deduction at the individual taxpayer level. So this is a deduction at the individual taxpayer level. So any income that flows through to the individual taxpayer will qualify for this deduction. So yes, a PTP that qualifies for partnership status, or REIT dividends that are taken into account at the individual taxpayer level will also qualify for these rates.
So a REIT dividend, but not a RIC dividend.
I have not seen anything about RIC dividends, only REIT dividends. And I think the idea is that the REIT dividend is coming up from a real estate business.
Well, it could be a mortgage REIT.
It could be, but traditionally real estate has been a favored business.
Right.
Okay. So let's talk about the basics of the pass-through.
So we have a U.S. So we have a U.S. LLC that has an individual that owns 50% and has a corporation that owns 50%. And the income is $20 million. Assuming that the LLC is actively involved in a qualified business, that means it's not a specified business, the U.S. individual is going to have $10 million of income allocated to her on her K-1. You would say, okay, I want to take a 20% deduction on that and bring my rate down on that to 29.5. As we'll hear in just a minute, in order to take that deduction at the level of $10 million of income, the U.S. LLC has to have W-2 wage base. That it means that it has to have employees, or it has to have certain assets, and a certain number of assets. So assuming that we have those W-2 wages or the assets, the U.S. person will claim a deduction of 20% of the $10 million, and she will have reduced her effective tax rate to 29.6. Jennifer's going to talk a little bit about the details of this calculation and the pass-through tax.
So basically, if you have a qualified trader business, the deductible amount for that qualified trader business is limited to the lesser of 20% of the qualified the qualified business income, or the greater of, so essentially that 20% QBI has to be supported by the greater of 50% of W-2 wages, or the sum of 25% of W-2 wages, and 2.5% of unadjusted basis of all qualified property immediately after acquisition. So that 2.5%, you think of that as a business such as basically a real estate type business that goes out and acquires a building with borrowed money, and like a really big building for a lot of money, and puts it in service, and before it depreciates it or anything like that, it has a $100 million building that it bought with someone else's money, and it can support this deduction for the entire time it has that building with that $100 million, even though it depreciates it over time. So that's actually a really nice thing for a business that is going to have very little in wages.
So if I take your example, $100 million building, 2.5% of the unadjusted basis would be $2.5 million. Mm-hmm. And some of my W-2 wages, so the custodian, the building management people, anyone who actually, the marketing people, anyone who's actually operating the business, and they have a W-2 wage, I take 25% of that number. Mm-hmm. Generally, it's kind of low, but let's say that's another $2.5 million. So we're looking at the greater of 50% of my W-2 wages, which again is a small number, or in the case we just gave, $5 million. So they can reduce the amount of their tax by 20% of either their QBI, the lesser of that, or $5 million. So in our case, it would be $1 million, right? Because I'm assuming the QBI is going to be higher.
Right. Basically, they've got to, yes.
So $100 million is probably not it. You're probably looking at like billion-dollar buildings at 2.5%. In order to give you...
So we're talking about the big ones that are sitting in New York.
I wonder.
Yeah.
Ideally, that would work quite well, right?
Okay.
And so, essentially, the result is that 20% deduction may be reduced if there aren't sufficient W-2 wages or assets supporting the business. So, and again, this only applies to 2018 to 2025, although, of course, when all this came up, when this was working its way through Congress, there were many in Congress saying that it would all be extended, but that's neither here nor there at this point in time.
But that was done for scoring purposes, right, for the dynamic scoring? So that
just to get it through reconciliation.
Oh, okay.
Yeah, that's for the rules. And qualified trade or businesses have to be effectively connected with a trade or business in the U.S. or Puerto Rico under certain rules. QBI does not include investment income, reasonable compensation, guaranteed payments, or income for specified service business, which Joan already went through. So we have a little bit more detail on the next page. Essentially, specified service businesses, we go through it again. Essentially, law, health, accounting, actuarial science, consulting, athletics, financial services again. And now we've got it correctly, the reputation or skill of one or more of its employees. And it includes certain investment management services. However, as Joan alluded to, there is one way that someone who has a specified service business can, in fact, get the advantage of this definition. However, it involves making a lot less money than many people would want to make. If you have a small business doing a specified service and you are either single and you only make basically $157,500 plus $50,000, or are married and make $415,000 basically, married filing jointly. So with the married filing jointly, obviously your spouse can't be making any money, a lot of money, because then that would take you over the limit. Essentially, that would work for a small investment managed service business, perhaps. Maybe just starting out. I don't know. But the idea is that this would be one way that you could do this. And also, these threshold amounts would also apply to a qualified trader business. You would not have to worry about the W-2 limits or the asset limit or any of that. So it's a lot simpler, and it's a little bit disingenuous in the examples in the legislative history that they gave us. That all the examples are in that very small. Fall under that.
Yeah, under those numbers.
Under those numbers.
But let's take a classic case. Somebody starts a private fund, whether it's a hedge fund or a private equity fund, and they can sustain a 2 and 20 management fee and carry, and they raise $20 million to start. Very small fund. So 2% of $20 million is $400,000. So right off the bat, on a gross basis. Now these are net numbers, I'm assuming. Right off the bat, on a gross basis, it's likely that they're going to not be able to take advantage of this because once you add in the 20% carry, they'll be over the amount that they would otherwise qualify for this.
Yeah, I mean, maybe the first year.
So a startup fund or maybe a half-year convention, you start in the middle of the year or whatever, you might be able to, but after that, this is really not going to be of significant advantage.
No, I would agree. I mean, it's not, but... Okay.
But it applies on an individual basis. So if I have multiple partners,
right? If you had multiple partners, then it might work. And of course, in the first few years, they might have significant expenses too.
Right. So there is possibility, but the solo investment manager starting a small fund, there's not going to be a lot of bang here.
No,
okay.
We don't think so.
No, we don't think so.
All right, David, you're going to talk about some deal structures. Page 9.
Yeah, sure. So this really ties together a lot of the concepts we've been talking about until now. And I guess what the question addressed on this slide and the next slide is how does this affect the decision to structure a business as a C Corp or as a flow-through, an LLC taxed as a partnership or as a partnership? And what are the considerations that go into that decision? In terms of the plus side for a C Corp, as we've talked about and as Joan mentioned, it frees up cash flow. You have a 21% rate compared to 35% rate. All of a sudden, you have all this additional cash to reinvest in the business. There is the accumulated earnings tax, which is, as Joan said, still good law. It's not something practitioners and business people focus on a lot because it hasn't been implemented as a tool. There needs to be specific requirements for that tax to kick in. It's not self-adjusted. It's only imposed if the IRS imposes it on audit. But it's still good law, and what that means in effect is that if a taxpayer takes too much advantage of this and just keeps all of the cash in the business when there's no real need for it, that there could be an additional tax, a 20% rate, that could be imposed.
And so just as background on the AET, you're allowed to, what the service would look for to contest is the accumulation of earnings that are not being accumulated for the reasonable business needs of the entity. So back in the days when the AET was imposed on a more regular basis, we would spend a lot of time helping people document the fact that they didn't make a dividend distribution because they thought that there was a reasonable need to keep the money in the business, and you go through the analysis as to why. Where we see this in the investment fund world, where it might actually give the service reason to think about it, are blockers. So you've got non-U.S. people who come into a structure that is a flow-through structure, or you've got tax exempts that come in through a flow-through structure, and you don't want to have the exposure to coming right into the entity, so you would put a corporation in between the investors and the portfolio company. That is an area where we have worried about it because it's hard to see why the blocker should have an accumulation of earnings Because what's its reasonable business needs? Well, I mean, sometimes you might need
to buy another fund.
Well, you might need to put more money back into the company. There's lots of arguments for it, but that is an area where we do think about it and worry about it some.
One of the issues, and again from a securities point of view, that we have been focusing on with blockers is the utility of personal blockers as opposed to blockers that are formed by the fund company itself. The traditional structure is the fund company has a master fund, whether offshore or domestic, and then sets up an offshore fund as a foreign corporation in a haven in order to avoid entity-level tax, but act as a blocker for, charities, etc. The problem now is if that blocker all of a sudden is subject to an AET, or potentially one way to avoid that is for the charity, the foundation, to set up its own blocker and use it to make its foreign investments. That way the U.S. charity can control when and if it wants to make a distribution and potentially avoid those issues because you're no longer relying on the manager to make those decisions. But, of course, that means now that the U.S. charity has to maintain an offshore investment company, which has its own complexities, and certainly give us a call if that's something with which you need assistance. David, what about flow-through preferred?
So the benefits of flow-through, so certainly if you qualify for the deduction, you get the lower rate, which in effect comes down to 29.6% after factoring in the deduction.
So 7% differential off of current rates?
Yeah, approximately 7% at the top marginal effective rate at the individual level. So there's that. There's the cost of a flow-through. I mean, the primary cost of a flow-through is the tax distributions that need to come out to fund individual tax rates. And as we've talked about, in addition, it's not a lot of people in the fund world don't necessarily qualify for the deduction.
But hold on a second. In private funds, generally there are no tax distributions. The cash is held inside the fund. Certainly in the liquid funds. Maybe in private equity, but there in private equity, the cash goes out when there's a realization event and the tax follows the cash. So in funds, there's always an expectation that, private funds like a hedge fund, that the investors will have to pay their taxes based on K1 income without the benefit of a cash distribution.
So in a case where you have a fund that there's no expectation for tax distributions, then that the cash, the business could reinvest, and the individual investors would come up with their own cash to fund those. Then in that sense, it would be similar to the corp, which has the ability to reinvest the proceeds after the 21% corporate level tax. And in fact, the LLC, assuming there's no tax distributions, would have even more cash because there is no entity level tax for a fund treated as an LLC, a partnership for tax purposes. So again, it really depends on the particular facts and what the expectation is in terms of the cash proceeds and whether those will be reinvested out in the short, reinvested and distributed out only at a later point in time, or in the short term, whether some of that cash is going to be distributed out either as distribution of earnings or to fund tax liabilities.
So for those listening, again, you need to look at your partnership agreements and your PPMs and make sure that your distribution policy is absolutely clear. Because if investors are expecting cash distributions to pay taxes, that needs to be disclosed. If there is a policy not to pay those, then that also needs to be disclosed.
And I think the other thing that we're asking people to consider now, to the extent they have LLC agreements that are anticipating distributions, what's the rate?
What highest maximum possible?
Well, no. I mean, the question is: do you assume that people are going? If you're not in a specified business, do you assume that the rate is 29.6? Because that's if you've got corporate shareholders by any chance, corporate investors, do you assume did they get 21 and everybody else gets 29.6? They're not going to be very happy with that. Where people need to be looking now at their existing partnership agreements or LLC agreements and their tax distribution section to see if it's going to make sense going forward from 2018 through 2025.
That's right. And then, the other more traditional things you think about when you talk about LLC structure versus C Corp structure, those have not gone away. Like, you still have the considerations of, well, if you're on the exit of an investment, will a buyer prefer to buy assets or LLC interest versus corporate stock? Are they going to want, like in the private equity world, private equity funds typically are focused on getting the basis step-up associated with the purchase of assets or LLC interest as opposed to purchasing stock in a C Corp? So all of those still remain, and then as an additional layer to those considerations, we now have to think about the new tax rates and how those will impact those decisions.
So much was made in the press around the Act about the fact that current expensing of tangible property has been imposed or allowed. I guess the last time we had that was back in IRTA in 1981, the Economic Recovery Tax Act, which of course was viewed as such a giveaway that following that we had massive tax legislation to close the hemorrhaging in TEFRA, DEFRA, and the Tax Reform Act.
And it didn't last very long.
It didn't, but it was 1 year, and it basically was part of the Reagan Revolution to re-energize the economy. So is it, history repeating itself here?
Well, it is going to change some behavior. The general rule is that you're going to a taxpayer is going to be able to take a current deduction for the cost of tangible property that it acquires anytime after September 27th, 2017, and this also sunsets, doesn't it?
Yes, it does.
At the end of 2025. So if you are a capital-intensive business, for example, one of our clients is a quarry mining company, and they spend a lot of money on big equipment. The equipment that they spend, they're going to now be able to expense in the current year, and they will take a very large deduction for that.
So what's property with recovery period of 20 years or less? That doesn't include real estate.
It does not include real estate.
So no real estate. How about capital improvements to real estate? That still follows the real estate, like a new generator or
the generator is a piece of tangible property that
would normally be expensed over how many years? 5 years?
Whatever the rule says.
Right?
Yeah. But now you're going to be able to deduct it in the year up front. There were in some of the iterations of the bill, because you'll see in a couple of minutes that you're going to have limitations on your interest deduction. There were some iterations of the bill when you could either have full expensing or you could take all of your interest deduction. That optionality is not present in the bill. If you buy tangible property, you expense it in the year of acquisition.
And a key point here, it does not apply to goodwill.
It does not.
So if I buy assets in an acquisition...
It has to be tangible property.
It has to be tangible. So goodwill doesn't apply. So, I buy a restaurant franchise that has 100 franchises, and a lot of money is in those signs. Is that tangible property, or is that goodwill? The intangible property is the copyright that's on that sign. But the tangible property is the signage
but the signage probably doesn't have a whole lot. I mean, you can buy the sign for $10. You put the logo on it.
It's $1 million.
And now it's $1 million. You're only going to get it to expense the 10. But Jennifer's going to take us through 2 examples of deals that we see to give you a sense of where you might see this, other than just going out and buying a new tractor.
Right. So what you frequently see on slide 13 is that we have a buyer who is buying all the interests in an LLC from the 2 owners of the LLC. So, in effect, what is occurring there under current law is that the buyer is buying all the assets of the LLC, and that is considered a full asset purchase by the buyer, and therefore the buyer treats that as if he bought all the assets. So now, under current law, he always was, well, not always, but since 1999, under Revenue Rule 99-6, has always been treated as buying all the assets. But now, he's able to...
So we would step up the basis of those assets.
Yes, he's going to...
And then we would immediately expense those assets.
Except for the goodwill.
Except for the goodwill.
Right, intangibles.
Where intangibles like, covenants not to compete or any of that other
Right.
stuff. Right, okay.
So that's the way it is now going to be treated because of the expensing.
And now it's going to put significant pressure in deals.
It is.
You want to talk about that a little bit?
Yeah, so the interesting thing is that in the past, and we've been doing this for quite some time, we've had this negotiation over the allocation. But there really wasn't that much of a tension.
So the allocation was the allocation of the purchase price among the different assets?
Yeah, so you have the allocation and you've got equipment. And you would say a lot of times that you'd allocate net book to the equipment. And basically the residual value would go into that goodwill. And the equipment was a shorter life, and, it would depend a little bit on what was going on here. But now that equipment is going to have a lot more importance to the buyer. And, of course, the tension in the past, which will still be a tension, is that, but it's going to have a lot more importance, is that the seller really didn't want much allocated to the equipment because that's going to make the seller pick up the amount that they have depreciated.
Depreciation recapture.
Right, the depreciation recapture.
As ordinary income in the year of the sale.
So that was why frequently you would agree to for the buyer to simply allocate net book, because that way the seller wasn't picking up that depreciation recapture.
But
now you have a lot more.
Intangibles have to be amortized over 15 years, right?
Yeah, but it used to be from a GAAP perspective, public companies that were acquiring assets really weren't terribly interested in stepping up the value of their book assets because from a GAAP perspective, they were effectively moving more income. They effectively were having a problem reconciling their goodwill with their tangible asset allocation. So most public companies would have said, we're not going to try and step up the basis of the tangible property. Now they're looking at it and they're saying, wait a minute. From a cash flow perspective, I might be willing to live with my GAAP inconsistencies because from a cash tax perspective, I can write it off in the first year.
Yeah.
Yeah, but remember, once you write it off in the first year, you've written it off, and you no longer have the shelter of those depreciation deductions over time.
You do, because you're probably not going to be able to use them in the first year.
So you take an NOL.
You take an NOL and you carry it forward.
There's no limitations on the NOL?
Well, you can carry forward the NOL forever. The NOL actually grows each year by an inflation factor or by an imputed interest factor.
So it's actually better for me to expense, even if I don't have the income in the current year, in order to effectively get a growing NOL.
Well, first of all, you don't have a choice. They did not.
You have to. This is mandatory.
This is mandatory. They did not give you optionality here. So the only way to make it optional is to work through your allocations.
Right.
Okay. So the NOL going forward, as I said, will grow. You can use it forever. You can only offset it against 80% of your taxable income in any given year. We no longer have an AMT, but that's the functional equivalent of the AMT.
And you also have to worry, again, if you have a change in the ownership of your business, your NOLs may be limited on the old 382.
Right, which is still in effect, yeah.
We have about 10 minutes left, and we still have a lot of material to cover. So quickly, why don't we go over how the Tax Act changed the financing, and then get to the last couple of topics.
Okay.
So from a high level.
David's going to pick that up.
Sure.
Okay, from a highlight level.
At a high level, as everyone has probably heard, there is a new limitation.
I wouldn't say that because Greg was sitting in my office the other day saying, this can't possibly be true. So
the limitation on interest deductibility, which cannot possibly be true, can be summarized as follows. Just think. Well, the general rule. Before I get to an example, just sort of illustrating traditional structures and how this might impact structures going forward. But at a very high level, there's a new limitation on deducting interest, and that limitation is that net interest expense, which simply means the excess of interest expense over interest income. So net interest expense is deductible only to the extent of 30% of adjusted taxable income. And I'll illustrate that by way of example shortly, but just to sort of think through using the slides as an illustration of how structures typically work and how leverage structures typically work and how that might change. So what you see on slide 15 is a very basic illustration of a simple leverage buyout where holdco, once a private equity fund forms holdco to buy a target and borrows money from a bank to do so, but wants to use that bank debt as a way of getting out cash from the operating business on a tax-efficient basis, and also wants to take advantage of its interest deduction at the business level. So by forming a merger entity, which is transitory and merges into the target, in effect, and that merger sub is going to be the borrower of the bank debt. In effect, what's happening is that the target that's being acquired is, from a tax perspective, treated as the borrower of that debt. Therefore, when Target and its group has earnings and uses those earnings to support the debt service, those payments will be tax deductible, resulting in a decrease in tax liability at the business level, and also results in a way to get cash upstreamed out of the business without having to worry about paying dividends at a corporate level. However, under the new rules, some of that might change, because once you have a significant limitation on your ability to deduct interest, buyers may not want to have a corporate level structure that relies on interest deductibility to free up cash, which is a lot of the modeling relies on. Just to explain very briefly how the new rules work, on turning to slide 17. So one thing to note is that this is a replacement of the historic earnings stripping rule, and then the way the earnings stripping rule went very generally was that it was a limitation on deductibility of interest payments to a related party when the payor was thinly capitalized. And in those events, when you had a thinly capitalized borrower paying interest to a related party, for example, the structure Joan mentioned earlier, where you have a foreign investor forming a leveraged blocker to invest in a portfolio company, that leveraged blocker could only deduct interest payments that it pays out to its foreign investor up to a certain extent, depending on the level of capitalization, debt-to-equity ratio, etc. That's all gone. Instead, this new limitation is intended to be more broad in the sense that it doesn't necessitate a related party analysis, and it doesn't depend on the thin capitalization rules. It just tells you that you can only deduct interest up to 30% of adjusted taxable income. What is adjusted taxable income? It's generally taxable income, but without taking into account any income or loss that's not related to the business, to the qualified business that the interest payment relates to. It doesn't take into account business interest or expense, because you've already taken that into account when you talk about net income expense. And it also doesn't take into account depreciation or amortization until 2022. After 2022, it does take it into account. So just to illustrate all of that, what that means on a very simple level, let's assume you have a business that has gross income of $1,000. And again, very simplified, has salary expenses of $400, has a net interest cost of $300, and has depreciation for the year of $200. So for the year, you would take $1,000 minus compensation of $400 would get you to $600. Then you reduce it by another $200 for depreciation. That would be what you would get until 2022. So you'd have a $400 adjusted taxable income. You would not reduce the $400 by the interest cost of $300, because that's where the limitation applies. So now you say, okay, what's 1/3 of 400? Your adjusted taxable income is 400. What's 1/3 of that? That's $120. So your $300 of net interest expense is deductible only to the extent of 120. The remaining 180 is a carry forward, and you can use it another year to offset income of this business to the extent the same limitations.
So this creates a bias for equity as opposed to debt financing of acquisitions, because in equity I don't have the interest expense, even though it might be determined to be like a preferred dividend or something else like that, right?
That's right.
Except for the fact that the leverage of using somebody else's money to do the buy is still a very powerful tool, and will ramp up your return.
Now, what about things like, because this applies to partnerships, trusts, and every other structure, right? Not just to corporations.
So it does, and there are special rules that apply that tell you how to apply this limitation to a partnership or an S corp. If you want to look at those briefly, I've outlined them on slide 21. The limitation is actually applied at the filer level, meaning at the entity level, which files a tax return. So the partnership, for example, would compute the limitation relative to its adjusted taxable income, and then any amount that's limited would flow through to its partners, because again, a partnership doesn't pay tax; it's just any tax liability from the business flows up. So any limitation or amount that's disallowed as a deduction would flow through to each partner. If there's an excess business interest, meaning if there's an interest expense which cannot be used and it's carried forward to each partner, and then each partner uses that interest expense in the next year for which that partner does not have a limitation. So what I mean by that is that for the first year, you make the calculation by reference to the partnership. Once you have an amount that's limited, that gets allocated to the partners, and then that's theirs, and they have to include that in their own calculations for the next year that they have an allocation from this partnership.
So how do you like tax simplification?
Yeah, right. Well, the one structure that immediately comes to mind, does this affect REMICs? Does it affect taxable mortgage pools? Does it affect, probably not Ginnie Mae's because they're considered grantor trusts, but what about securitization vehicles, where you have a special purpose vehicle that goes out, buys interest-producing assets, and then turns around and issues debt instruments, like in a traditional CLO, issues debt instruments that are paid out of, the return on those debt instruments is paid out of the interest received. Is that considered business income? Because if it is, that means the equity holders now have effectively connected business income, right?
You know, every time we do this, Greg, you throw me one question that you haven't asked me before.
I certainly don't think that it affects REMICs, because REMICs are
they're statutory.
They're statutory, and those code sections were not touched. So, I mean, I think it's fair to say that REMICs are completely unaffected by this until someone touches those code sections. So I think it's fair to say that REMICs are totally untouched. I also think it's fair to say that the people who drafted this in Congress knows far less about the other things that you asked us about than anyone in this room, and to think that they considered it is a reach.
And then when you think about how the limitation would apply, right, the question becomes whether this is a qualified business. Whose qualified business is it? Is it of the investor?
And it's generating qualified business interest income, right?
That's right. And is it the investors? Are they in the business of investing in this, or is the REMIC or the entity in the business of securitization? And to the extent it's not a pass-through vehicle, but it's taxed as an entity at the entity level, you'd have to make the calculation there. So it gets a little complicated and certainly worth further analysis and thought when it comes up.
Well, we are at the end of our time. Hope you enjoyed the discussion. I certainly found it fascinating, and I think the best I can recommend is hold on to your armchairs, because it's going to be a very interesting year as we figure out the implications of the Tax Act on our normal business activities and investment activities. Of course, if you have any questions, please feel free to contact me or any of the other participants on today's program. And we thank you for your attention and look forward to talking with you again on the next topic at the next session. Have a great day, everyone.